There has been a reversal of that decision from what we understand, and that means you won't pay tax on any assets until they're actually been sold. And when we're talking about the $3 million, it's $3 million per member. If you've got two members, you're talking $6 million in assets. So that's well and truly enough. If you had assets over $3 million in your super fund and you're planning on fire sailing them to pay the ATO tax on assets you haven't sold yet, what should you do now? Well, welcome to SMSF Insider, where we help busy professionals to gain financial independence using an SMSF. Hi, I'm Troy, founder of Blue Chip SMSF Services. And over the last 20 years, I've helped thousands of Aussies manage the complexities of self-managed super funds. And in this podcast, I'll answer your questions, break down the myths, so you can take charge of your financial freedom. Let's get into it. It's just a quick disclaimer and just a reminder that this is not personal advice. So make sure you speak with a licensed advisor before making any investment decision. Welcome to this edition of SMSF Insider, where we'll be talking a little bit about the unrealized capital gains tax that was recently announced quite a few months back by Jim Chalmers. We saw last week Jim Chalmers come out and has backflipped on the unrealized capital gains. And what we've done an episode on this in the past, and what it meant was any super funds with more than 3 million were going to be taxed on any amounts over 3 million, regardless of whether those assets have been sold or not. And I think due to the backlash around taxing retirees on assets that haven't been sold yet, due to that backlash, there has been a reversal of that decision from what we understand. And that means that the clients will have to, or you won't have to sell any assets until, or you won't pay tax on any assets until they're actually been sold. So that unrealized capital gain doesn't look like it's coming into effect, which is a great result. It's good to see the Jim Chalmers and the current Labor Party come to their senses on this. But what that means is, moving forward, is that you will still be taxed at the 30%, so the additional 15% on assets over and above 3 million, but you won't be taxed until those assets are sold. Any assets under 3, so any funds with assets under 3 million, that will still remain at 15%. And when we're talking about the 3 million, it's 3 million per member. So if you've got two members, you're talking 6 million in assets. So that's well and truly enough. But if you're a single member fund, then certainly 3 million was going to be affecting about 80,000 retirees. So looks like that they've backflipped on that, which is a great result for all those hardworking retirees that have saved their backsides off for their entire working life. And then they've also, there's an additional 25% tax that will apply, looking like it'll apply for the larger balances that are over 10 million. So again, it's not affecting a large percentage of population, very small percentage of population, but certainly it'll affect some. So that just means any assets over that 10 million, that they'll be taxed at 40% as opposed to the current rate, which is 15. So thought I'd just touch base and give everybody an update on that. It's good news for those balances with 3 million or more. Those assets won't be taxed until those assets are sold. What does that mean for you? Well, nothing. Absolutely nothing changes. You'll still be taxed at the 15%. Right up until 3 million. And then once your account balance reaches over 3 million, it's at that point where your assets over and above that $3 million mark will be taxed at an additional 15%. So if your account balance goes from 3 to 3.5, for example, that extra 500,000 will be taxed at an additional 15%. So anyone under the 3 million, nothing has changed. It's still investing as usual. It's really only affecting those above 3 million, which is a small percentage of the population, but it's good to see the Treasurer come to his senses with unrealized capital gains, and they will no longer exist according to the announcement last week. And then there's also some additional changes for balances over and above 10 million, which obviously affect a very, very small percentage of the population. But those that are affected what that means is you will pay an additional 25% tax over and above the 15. So those balances will be taxed at 40% once those assets are sold. So anyone under 3 million, play on, business as usual. Anything over 3 million, between 3 and 10, you'll be taxed an additional 15% once your assets are sold. And then once you get over 10 million, if you, for those that are savvy enough to get there, then you will be paying an additional 25%. So you'll be paying 40% on those assets once you reach over that $10 million mark. Just quickly, guys, if you're a busy professional, fed up with traditional super funds and overwhelmed by the setup of your SMSF, we can help. Book in a call with my team using the link in the show notes, and let's build your future on your terms. Now, back to the episode. So just a summary of the key changes here. No unrealized capital gains tax for assets or super funds over 3 million anymore. Those assets will need to be sold before the tax is due, which completely makes sense. Just want to touch on as well just those asset classes that are a little bit easier to value at the end of a financial year or at any given point in time. Shares being one of them. Crypto coins being another. Those assets have a definitive value at any given point in time. Property, however, is a little bit different in that they're typically not listed. So it's very hard to value a property at any given point in time unless you have a valuer go out and value it. You can't sort of go back in time and say, what was this property valued at specifically on this given point in time? You can have an estimate, but certainly property is a little bit harder to value. But certainly the listed assets like shares and crypto and bullion, for example, are a little bit easier to value at any given point in time. So good decision by Treasurer Jim Chalmers to abolish unrealized capital gains. Very kind of you not to tax us on assets we haven't sold yet. Thank you very much. And assets over and above 10 million, which does affect a very small percentage of the population, but they will be taxed at 40%. Moving forward, according to the bill. This is just a bill. Nothing is actually legislated as yet, so there could be further tweaks. So stay tuned, and we'll be sure to keep you updated with any movement or any changes to this bill. So what should you do now if you were planning on selling some of your assets? If you had assets over 3 million in your super fund, and you were planning on fire saling them to pay the ATO tax on assets you haven't sold yet, well, you could stop doing that. No need to fire sale your assets that you've worked hard for. You can leave those in play, and there'll be no tax due on those until such time that you decide to sell them, and whether that be in the immediate future or long term, but certainly no need to go out and fire sale those assets. So the unrealized capital gains tax was going to be introduced on July 1 this year. That has been pushed out to July 1 or commencing July 1 next year, so 2026. So they've also given everybody a year to I guess absorb and plan for these changes. The unrealized, of course, has been looks like it's being abolished, which is fantastic. However, and they've also given everybody an extra 12 months to plan for these for the other changes, which is simply, for the most part, it'll just be additional tax for assets that are sold over and above 3 million, pay the extra 15%, so a 30% in total, 15 up to 3 million, and then an additional 15% for the asset value over the 3 million. And then, of course, the hard saving retirees that have more than 10 million, that they'll be taxed at the additional 25%. Over and above the $10 million mark. So that is all coming into play. It's been pushed out for another extra 12 months to give retirees and investors an additional 12 months to plan for these changes. At this point in time, they're the current current tweaks. By all means, there could be further changes that happen between now and then. So if there are any changes, we'll be sure to keep you updated with what those changes are. I think the main reason that the Treasurer Jim Chalmers has changed or backflipped on the unrealized capital gains is probably due to backlash. Having these retirees fire sale assets, or even if they're not fire selling, if they're keeping them, paying tax on assets they haven't even sold yet. I'd imagine there would have been quite a bit of backlash about that, even with their own voters. So that, I think, would be the main reason that they would have changed or backflipped on the unrealized capital gains. I think probably due to pushback. It is one of the most unfairest taxes that we've ever seen in Australia, I believe, taxing investors and retirees on assets they haven't even sold. So I think due to pushback and backlash, I think would have possibly been the main reason that Jim Chalmers has backflipped on that bill. So if you have any questions, please drop the comments. It's in the comment section below. And if there's anything else you'd like us to talk about, please drop it in there as well. Thanks for listening to this edition of SMSF Insider. Thanks for tuning in to this episode of SMSF Insider. If you got value from this, make sure you subscribe so you never miss the strategies we share to help you take control of your financial future. Find us on socials at Blue Chip SMSF or book a call with our team to see if we can help you.